The deflationary forces from the tech stocks breaking in 2021, probably too big. The power of interest rates rising and depressing the real estate market, very negative, slow-moving influence. I suspect that they will once again dominate, and we will have a recession running perhaps deep into next year, and an accompanying decline in stock prices.
So the recession that you're predicting is probably not going to happen in 2023, but
it may start in 2023.
The Federal Reserve recently said that they think we've cleared the recession hurdle, and they don't really project a recession any longer.
Right.
You disagree with the Fed on that?
Yeah, I think the Fed's record on these things is wonderful. It's almost guaranteed to be wrong. They have never called a recession, and particularly not the ones following the great bubbles. They prided themselves in stimulating the bubbles. They took credit for the beneficial effect of higher asset prices on the economy. They have never claimed credit for the deflationary effect of asset prices breaking, and they always do.
Now, you said not too long ago that you weren't a big fan of Jay Powell and the way he's been handling inflation. Is that correct?
Yes, that's correct.
And you think he's done a better job recently in getting inflation under control?
I think it's largely out of his hands. The forces work. I suspect inflation will never be as low as it averaged for the last 10 years, that we have re-entered a period of moderately higher inflation and therefore moderately higher interest rates. In the end, life is simple. Low rates push up asset prices, higher rates push asset prices down.
In the world of finance and investments, the insight of a billionaire like Jeremy Grantham can significantly influence market perceptions, and his latest interview has certainly made waves. He describes a scenario that is far from optimistic, suggesting an impending storm rather than a continuation of sunny market conditions. Grantham's alert is clear and alarming. He predicts a tough period ahead for the US economy, with the recession looming, a recession that could extend well into the following year, overshadowing the prolonged period of the market growth that investors have been relishing. Following the global pause triggered by the COVID-19 pandemic, a sudden drop in demand led economies into a deflationary spiral that was unexpected. As economic activity resumed, the US government distributed stimulus checks. There was a remarkable boost in spending, especially in the tech sector, sparking a significant stock market rally in 2021. Though initially beneficial, this rally had unforeseen effects. The stock market's exuberance not only made many unexpected richer, but also contributed to inflation. The surge in wealth and demand put the economy in precarious position, leading to inflationary pressure. In response, the Federal Reserve took measures to stabilize the economy by raising interest rates in 2022, targeting not only the stock market but also overheated real estate sector. With higher interest rates and mortgage rates, the real estate markets now faces significant challenges. Grantham's bleak outlook is based on the interaction of these elements, the potential downturn from the tech stock bubble burst, and the repercussion of the higher interest rates could severely impact the real estate sector. This situation presents a slow-moving yet perilous shift in the economic landscape, where the previous drivers of growth could become the harbingers of a downturn. Grantham's cautionary stance serves as a warning light for the financial community. As it navigates through these evolving challenges, throughout the interview, Grantham critiques the Federal Reserve's optimistic projections, particularly challenging Jay Powell's management of inflation. Despite his criticism, Grantham acknowledged that inflation's future might be beyond Powell's control, hinting at a period of sustained higher inflation and interest rates.
The Federal Reserve recently said that they think we've cleared the recession hurdle, and they don't really project a recession any longer.
Right.
You disagree with the Fed on that?
Yeah, I think the Fed's record on these things is wonderful. It's almost guaranteed to be wrong. They have never called a recession, and particularly not the ones following the great bubbles.
Grantham message is a stark reminder that financial world is fraught with unpredictability he calls for preparedness against a potential downturn, especially with the possibility of recession in late 2024, which could unravel if the stock market bubble burst as feared. As a financial narrative, Unfold Grantham's interview stands as a sobering prompt that the vibrancy of the bull market may soon be overshadowed by looming economic challenges. Investors are left to ponder their readiness for the possible financial turmoil that could disrupt the market's current trajectory. The financial state is thus marked by caution, as the ongoing saga of market dynamics with its inherent uncertainties. As we witness the unfolding of complex economic dynamics, there is a palpable sense of foreboding. The possibility of a recession driven by the aftermath of the tech stock bubble burst and subsequent increase in interest rates looms large. This scenario, marked by rising interest rates, resembles an approaching tempest. Heralding challenges times, elevated interest rates, creating significant hurdles for both businesses and individuals. The Federal Reserve's efforts to temper an overly vigorous economy mean that borrowing costs surge. The scenario poses difficulties for consumers aiming to purchase significant assets like homes, underscored by a record-setting household debt level of $17.3 trillion. With the ascent of interest rates, the financial strain deepens. The growing challenge of affording a new acquisition leads to a widespread reduction in consumer expenditure. This retrenchment in spending triggers an immediate fallout, a swift decline in demand. Such a decrease in consumer activity adversely affects businesses across a wide array of industries. Diminished consumer spending translates into a lower business revenues, which in turn depress profits. This sequence of events extends its impact to government finance to reduce tax revenues. The stock market, a barometer of business prosperity, also feels the brunt of these economic shifts with revenues and profits. Dwindling the stock market's vitality wanes, the equation is straightforward. Businesses' difficulties reflect directly in stock market performance. In this context, Jeremy Grantham's caution gains added significance. The intricate web of economic relationships suggests looming difficulties. A recession, particularly one occurring alongside high interest rates, signifies a profound disruption capable of altering the economic landscape. Investors are thus compelled to contemplate the road ahead, wondering whether the stock market can withstand the brewing storm or if it will succumb to ensuing economic tumult. Grantham's advisory resonates within the financial community, highlighting the need for resilience as economic conditions evolve with this turbulent economic scenario, marked by the threat of recession and the challenges of high interest rates. The imperative for caution becomes apparent. Embarrassing a conservative stance is not only wise but necessary navigating through uncertain times. Such turbulence, gold emerged as a potential sanctuary. Historically, gold has been a symbol of stability amidst economic upheaval, maintaining its value, while other investment may falter. It represents a safe haven for those seeking to shield their wealth from the adverse effect of economic downturn. Incorporating gold into one's investment portfolio could be a strategic move, offering balance and stability. It's about diversifying wisely, enhancing the resilience of your investments against potential economic storms. Grantham's dire warning is a call to prudence in the volatile world of finance. As we face potential economic downturns and market fluctuation, adopting a caution approach and fortifying your financial defenses becomes crucial amidst the economic squalls and the bursting of bubbles. Considering the enduring value of gold as a stabilizer, ensuring your financial stability in tumultuous times.